Hello, I'm Alan Kohler, founder of Eureka Report, which is now part of Intelligent Investor, and finance presenter and columnist for the ABC.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.
And we are the Money Café. I didn't let you come in and join me to say that then, did I?
You had it covered, Alan. Sometimes the boss has got to take control.
Oh, there you go. Yes, well, how's the school holidays going, James?
It's going really well, Alan. I'm off this week and spending lots of time kicking the footy and shooting hoops and even taking the kids down to the driving range to show them how bad their father is at golf. So, it's been good fun.
Oh, there you go. That's good. Well, it's excellent to talk to you, even though you're on holidays and you haven't got the faintest idea what's going on. No, I'm sure you.
Not too much different from usual, so that's okay.
Yeah, well, you would have noticed yesterday that the US government shut down at 2 p.m. our time, which was midnight in Washington, D.C.
Yes. I was there's always sort of amusing stories that come out of this, or not amusing, but sort of, make you wince a little bit. And there's great stuff about how the people who run, these vast national parks that America's rightly proud of were given like 3 hours to figure out how to how to make the national park sort of run while the government shut down. I didn't realise, Alan, though, that there's non-essential workers who stood down without pay, and then there's a bunch of essential workers who have to keep coming in without pay. In air traffic controllers, and I think border control people at the airport and that sort of stuff. Lots of examples, but
I know, and they're required to front up for work.
Yes,
and then they get paid back pay when the government starts opening up.
Yeah, but it's a bit of a. It's funny how the burden falls on the ordinary worker, isn't it? Anyway, I just it all feels like a bit of the natural theatrics of American politics. But
well, that's right. Those, as you say, those workers who have to keep showing up are really the only losers. I mean, the share market was up. The US share market was up again last night, 0.3%. The S&P 500, 0.4% by the Nasdaq. And it's worth perhaps recalling, as I'm sure you do, that the last time there was a government shutdown was between December 2018 and January 2019, 35 days, during which time the US share market went up 0.4%. So it was unconcerned then, and it's unconcerned now.
Well, look, we'll see where it goes. I had breakfast a couple of weeks ago with a strategist from a mob called BCA in America, Matt Gertkin, and he said, look, all this Trump stuff's interesting, but you got to realize the cycle of American politics. So by the start of next year, everyone will be focused on the midterm elections. There's no way that the Democrats won't win the House. They'll win 20 seats, even if they're still a shambles, which it appears they are. And then by the time you get to late 2027, early 2028, everybody stops worrying about the president at all. They start looking towards the next president. And, of course, I asked if that will be Trump, and he said, no, that's even he's not that silly. But he did make the great point that a lot of this sort of polarization in America might be not sorted out, but at least calmed by the fact that we will have two presidential candidates in 2028 who will be either from Gen X or below. So you'll have you'll lose this sort of 80-year-old person who thinks they know everything that we've had for the last 8 years. And
I actually think your man's a bit overconfident that it won't be Trump, or at least Trump won't run.
Yeah.
I mean, he's got hats made, I saw yesterday.
Yes.
With 2028 written on the hats.
On the Oval Office desk.
I know.
Yeah. So, well, look, maybe you're right, but I thought it was an interesting, the cycle of these things is interesting.
Oh yeah, that's fair enough. I mean, Well, that's right. Well, we'll see. Anyway, the other thing that happened yesterday was that the Supreme Court deferred consideration of Trump's attempt to fire Lisa Cook. and it was just a sort of a statement that it'll be heard in January. The Supreme Court didn't express an opinion about it. It does look like she didn't do what she's being accused of doing, which is to lie on a mortgage application a long time ago. Stories are that seems to have not been true. But nevertheless, Trump's trying to fire her anyway.
Yeah.
And he's proceeding. So I don't know what the grounds will be. Anyway.
Yeah, look, I think what happens to the Fed in the next little while is clearly something to keep watching. So yeah, it's pretty nasty.
And speaking of central banks, no change by the RBA this week. Interest rates left on hold as entirely expected. Well, there was an 8% chance of a rate cut on Tuesday, according to the market.
I thought it was interesting, Alan, I don't know, would you call it a groundswell? Maybe that's the wrong word. The shift in opinion, the very big shift in opinion to people deciding that maybe we're almost done with rate cuts. The economists really moved, hawkish tone and all that sort of stuff, which we always love talking about. But I thought it was really noticeable the way economists have swung from, more cuts are coming to, maybe they're not.
I mean, as far as I can tell, there's no economist saying more than two. There's a few economists saying two more cuts. Most of them are saying one more cut in February, not in November. And you're right. There's a few economists saying that's it. The cash rate's going to be 3.6% for a while.
Yeah. So, it just feels like I wonder if, now we're getting the old productivity roundtable, the economic reform roundtable feels like it was a long time ago. But what I do find interesting is, Paul Bloxham from HSBC has had this argument for some time that, the rate at which, because the productivity is so poor, we very quickly get to the point where, there's a limiter on economic growth. Economic growth can only kick up so far before we get this big kick up in inflation. I think that's the problem we're now getting to, right? Where the economy can't grow that fast without inflation spiking because productivity is so poor. There's not much Michelle Bullock can do about that. She's got one tool, right? So, yeah,
that's right. So, but you're right. I mean, we've had that round table. It's kind of forgotten now. Nobody's. It hasn't been mentioned. And what we haven't had is a big kind of set of reforms, productivity-enhancing reforms from the government out of the round table. Nothing so far has happened.
No. The momentum feels gone. And maybe we should have always expected that, but I don't know. Anyway, I wish it hadn't worked out like that. Hopefully they've got some big shot in the locker. But again, I know you've said this about housing, but another so-called crisis where we don't actually act like we've got a crisis.
Yeah, that's right. And in fact, we had September house prices yesterday, which were up again.
Yeah.
In fact, the increases are accelerating, and obviously it's entirely because of rate cuts.
Yeah. Oh, well, not entirely, Alan, because now we've got this first home.
Up to now, I mean, the first home buyer deposit of 5% will obviously put further upward pressure on house prices.
Yeah. What have you made of the debate about that? It's funny. It's one of those things where everyone's known it's coming, but nobody's put two and two together until it's actually here. Yeah.
So the Treasury modelled the impact of it on house prices over 6 years, said it would be 0.5% in 6 years. And that seems to be at the bottom end of, as you'd expect perhaps, at the bottom end of estimates of the impact. Most other impacts are that it'll be higher. Obviously it'll put sort of more upward pressure on house prices,
Yeah.
So for the first 9 months of this year, house prices are up 5.2%, and that's an annual rate of 7% so far this year. And the whole reason we have a housing affordability problem is that house prices have been rising at 7% a year for 25 years. So basically it's still going on. And the attempts to increase supply to put a cap on house prices has not worked yet. you've got to say it's a failure so far.
Totally.
And I spoke yesterday to the New South Wales Planning Minister, and what they're doing and what Victoria's doing is nothing short of a revolution on planning. It's unbelievable what they're doing.
As in trying to force this density stuff through?
Well, they are forcing it through.
Yeah.
I mean, it's just, councils have got no say anymore. The state governments are just rolling over them. And basically they're raising height limits around stations all over the place in the suburbs.
Is it going to work, Alan, do you think?
Well, look, so planning, getting the planning and the approvals is one thing, but the problem, which I'm kind of talking about for the ABC piece for Sunday, is that the construction industry doesn't have the capacity at the moment to build that many houses. I mean, Build Skills Australia, which is a government body that looks at number of people there are, is saying that the construction industry is 117,000 tradespeople short of meeting the National Accord target of 1.2 million homes. And the number of apprentices is declining. So apprentice numbers are down. There aren't enough people already in the industry as tradespeople. The number of construction for building firms that are going broke is up. So, the capacity of the industry is declining, and so is the productivity of construction. So that not only are there not enough people, the people that are there are doing less, or at least getting less done.
Yeah.
So, I think it's a really difficult problem, and I don't think it's going to succeed at all.
Yeah. Okay. Well, that's a cheery note.
Yes. Another cheery note. What do you make of BHP and China? Was it true that China banned BHP's shipments?
Oh, look, I don't know. It's hard to see through the murk at the moment. Interesting development, though. I think it sounds like some sort of negotiating tactic. China's had this centralised buying agency for a couple of years now. I've got to say it's been a pretty much a failure. It's failed to sort of control the iron ore price in any way, which is fair enough. It's a spot price, sort of traded on a semi-open market. So this feels like this Chinese buying agency is trying to flex its muscles a bit. BHP's the target. But look, the Chinese steel mills still need BHP's iron ore. Mainly because it's a lot cheaper than the stuff that China's own iron ore mines can produce. And the Chinese steel mills are not profitable at the moment. They are losing money or barely breaking even. And so they don't want a big increase in the price of iron ore, which is what locking BHP's product out of the market would do. So I think this too shall pass. To talk about market reactions, the market reaction's been pretty muted. Interesting that Albanese was asked about it, as was the WA Premier, and they both sort of said, well, we don't want any complications for BHP exports, but this is all part of the negotiating story. So I think that's about it at the moment. This sort of outbreak of commercial tensions happens from time to time. But look, I mean, I think, we've got to... The other thing is it's a moment to stand back and recognise that iron ore, which has carried us through the last 30 years, is not going to carry us through the next 30 years in the same way. It's just not. Steel production has peaked in China. They will get better at using scrap iron to produce steel. And these electric arc furnaces that China's going to introduce it started to introduce and will increasingly introduce over the next 30 years or so, our iron ore isn't perfect for those. It's not high enough grade, so we need to find some technological solution to make it fit for purpose for these electric arc furnaces. And that'll be a little challenge for us. So we're just not going to be able to rely on iron ore as we have for the last 30 years. And I don't see anybody talking about that in Canberra. Ironically, it's been BHP and BHP CEO Mike Henry has been banging the drum loudest on that. He's been saying, time to wake up a little bit here, guys. It's just not going to be the same. But he hasn't been particularly heard on that, I don't think.
I must say, I think it's amazing that BHP didn't say anything yesterday. I mean, there's a report in Bloomberg that their shipments to China of iron ore have been stopped, and they didn't say anything. Like, isn't that market-sensitive information that they should comment on? I mean, crikey. They gave my colleagues at the ABC a on-the-record comment that said, we do not comment on commercial negotiations.
Yeah, look, I don't know. I mean, they're negotiations at a moment in time. What do you want, a running commentary?
No. To say something about a report that 60% of their iron ore was not stopped. 60% of their iron ore volumes was stopped or not. I mean, the market had to trade yesterday. The stock price was down 2.5%. But if that was true, then it should be much more than 2.5%.
Yeah, fair enough.
And if it wasn't true, then they shouldn't have gone down at all. I mean, I just think it's unbelievable, really, that they didn't say anything. Anyway, even if it was just, I mean, clearly what they're saying by saying we do not comment on the commercial negotiations, that's implied in that is that it is all about a commercial negotiation, right?
Yeah.
Which is kind of, but that's only implied. I mean,
no, fair enough. Fair call.
Yeah.
I think they're in a tough spot, but yeah, I do take your point.
Yeah, what else is going on? What else can
big merger in media land, which is interesting on a number of counts. So Seven West Media, which owns the Seven Network television, and there were a bunch of newspapers in West Australia, so the West Australian and some other media properties. They're merging with Southern Cross, which owns radio networks. And so this is interesting on a few counts. So one, you've got the Stokes family. So Seven West has been 40% owned by SGH, which is the Stokes family's sort of conglomerate. It owns Boral and Westrac, the big supplier of Caterpillar trucks and diggers. It owns Coates Hire, and it owns Seven West Media. But the media business has been a bit of a stinker for a fair while, a bit of a drag on the conglomerate. So this is a way of trying to force a bit of consolidation in media. It's that old question, Alan, you would have seen a million times in your careers. Does putting two sort of struggling business together suddenly make one good business, or does it make an even bigger business?
I did note on the day that it was announced, the share prices of both Southern Cross and Seven West Media jumped by more than 5% at the time, which prompted me to say on the news, well, apparently two wrongs do make a right.
Yeah, I ain't sure about that is what I would say.
Yeah.
And then there's this other really interesting thing. So, well, it's interesting to me, and lots of people are talking about it in the market. So Southern Cross has structured this such that while Seven West Media investors will get a vote on the deal, Southern Cross investors won't. That's even despite the fact that Seven will have 99.99% of the business, just under 50%. Had Seven had 50% of the business, they would have had to do allow Southern Cross investors to vote on it too. But it's brought into sharp relief the ASX listing rules, which have been now a topic of conversation across a couple of deals, including the James Hardie deal, where they recently bought this US decking products maker called AZEK. It's been a bit of a disaster already. And again, James Hardie did this deal but didn't allow investors to vote on it. And there's a lot of fundies saying, hang on, if you're going to do a big deal where the target gets to vote, we want to make sure we get a vote too. And we want to change the ASX listing rules to ensure that happens. So just watch this one, Alan. It's a real campaign against a lot of fund managers. You know, active fund managers have been pushed around by passive ETF providers. They've lost a lot of market share to them. They've lost a lot of their power and influence, but they still want to have a say on these big deals, and they feel like they're being shut out at the moment. So this deal has again brought that into sharp relief. So one to watch.
Yep, very good. Okay, all right. Before we get to questions, here's a quick word from our sponsor.
Want to enjoy retirement on your terms? Whether it's travel, hobbies, or more time with loved ones, the key is planning ahead. With longer lifespans and rising costs, relying only on the age pension and employer contributions may not be enough. That's why InvestSmart has created a free retirement ebook. It includes practical strategies to make the most of your super, what you should know about self-managed super funds, and why it can make sense to invest outside of super. It's never too early or too late to start shaping the retirement you want. Download your free copy today at investsmart.com.au/guides.
Okay. Mitch says, my question is around the expanded first home buyer scheme. With all the talk about the scheme being expanded, why aren't we seeing pushback on the fact that the scheme excludes individuals who have previously owned land but never built or bought the land more than 12 months ago? Seems counterintuitive to the government's plan to build more houses and make housing more accessible to young Australians. Yes. Well, they're basically trying to limit it to people who aren't rich, I guess. Is that right?
Well, I think Mitch is saying that there's no exclusion if you haven't on the fact scheme. Oh, excludes individuals. Yeah, okay. I think they're just trying to make sure the eligibility is not. You don't get two bites at the cherry, don't you? Do you?
Yeah. Well, so they're basically. I mean, they're nationalising the mortgage insurance industry, but not entirely. You know, so they're trying to limit the damage, I guess.
But I think if you've previously owned land, you shouldn't get a second bite of the cherry as a first home buyer, should you?
I guess not. You know,
I take Mitch's point, but like presumably that land was bought and sold, so those people have had a crack at building up their deposit. We don't.
Okay, Mitch. So we reckon that's fair enough, Mitch.
Sorry. Ashley says, I recently turned 50 and I'm contemplating what to do with my super. I've 10 plus years before I can touch it. And I had the thought that in 10 to 15 years' time, climate change will be a much bigger issue. There's also a lot of climate-related stocks that are, in Ashley's opinion, undervalued at the moment and will be maturing over the next few years and raking in the cash in around 10 years' time. I was thinking of setting up an SMSF and investing in stocks that are geared towards the environmental challenge ahead. Do you think I am foolish taking a long-term view in this economic climate? Should I just leave it in a diversified portfolio in CBUS like everyone else? What could go wrong? And as Ashley says, no personal advice, please.
Yes, well, we can't give you personal advice, Ashley, because we're not licensed to do that. We don't know anything about you. But, yeah, well, I think with climate, it is a long-term issue, obviously. And in 10 years' time, you're right, it'll be a much bigger issue than it is now. But the trouble is that there aren't many ways to invest in it in Australia. I mean, there's not that many ASX listed stocks that are engaged in it. You know, you could list in foreign stocks, but I mean, one of the few is Infratil, which is a developer of solar farms, which it then sells. It's a bit like a property developer. It builds solar farms and then sells them to super funds. And it seems to be a good business. So that's one way to do it.
The other thing I'd say, actually, again, no personal advice here, but setting up an SMSF is a big thing. It's a big thing with big costs and big obligations and responsibilities and a certain amount of knowledge required. So I'm not sure I would be doing something so dramatic just for that. There are options in some super funds. I'm not promoting this one, but I'm just picking a name off the top of my head, such as Australian Super, where you can use a portion of your balance to pick individual stocks. So something like that might give you the best of both worlds. If there's a climate-related stock that you think might be worth specifically putting a bit of your super in, but you're not leaving the sort of not safety is not the right word, but you're not leaving the mainstream super fund infrastructure behind. So maybe you can have a bit of a foot in either camp there with something like what Australian Super offers.
Yeah.
It's their direct investment option, I think, if you do a bit of Google.
Another thing is that this is a bit of a left field, but I think the big thing in 10 years, 15 years' time is going to be fusion energy, which is the other form of nuclear energy, other than fission. So nuclear energy at the moment is fission, where they split atoms apart to create energy. Fusion is where they put them together. They bang atoms together to create energy. And the energy created is there's much more, but it's much harder to do. But there's a lot of activity now going on to develop fusion. And in about half an hour this morning, I'm going to be talking to Sam Cecilia, who's the Chief Investment Officer of Host Plus. And they have invested in an American business called Commonwealth Fusion Systems, which has actually done the first deal 2 weeks ago to sell fusion energy to the Italian electricity company, ENI. So they've done a $1 billion deal to sell that much fusion energy to ENI in 2030, I think it is. So Commonwealth Fusion is expecting to build their plant, start constructing their plant in 2027, 2 years' time, and that it'll start producing by 2030. So there's probably a reasonable chance that this is all the go then, because fusion doesn't require plutonium and uranium like fission does.
There you go.
It uses hydrogen isotopes, deuterium and tritium, which are in water, and there's enough fuel in the world's oceans to entirely to entirely power the planet for millions of years. Right. So I think, Australia's ban on nuclear energy doesn't include fission. It doesn't include fusion. I mean, it only really applies to fission. So, look, I reckon maybe if you're thinking about super funds, maybe Host Plus, you should have a look at Host Plus, because they're all about it. And I'm going to find out more this morning.
Interesting. There you go.
Yeah. Reece says, I've been researching our net zero energy transition, and I'm concerned about the high percentage of foreign ownership in our renewable sector. The best estimates I could find are that roughly 72% of large solar projects and 70% of large wind projects are foreign owned. I'm struggling to see how this could be in the best interest of Australians. For starters, a good chunk of future revenue from our grid will now flow overseas, and as these companies are naturally profit-driven, it's in their best interest to lobby against any meaningful price reductions or policy changes that benefit Australians at their expense, not to mention the fact that taxpayers are subsidising this. Is foreign ownership of our grid a concern in your eyes? Well, Reece, I must say that the idea that Australian companies are going to be better interested in, responding to lobbying for price reductions and policy changes that benefit Australians is fanciful, because they're not going to be any different.
Yeah, Reece, I think you find the big guys like Origin Energy and AGL are moving harder into this space over time. They've obviously had to balance their fossil fuel generation with their renewables business, so that's maybe slowed them a bit. That weren't the original investors. The other complication is we haven't seen the super funds get into renewables in a big way, despite lots of talk about it, because they just can't make the economics stack up. They haven't been able to figure out the return profiles. And so I guess I would say I'd take your point that perhaps huge amounts of foreign ownership is not good, but we want someone investing this capital. Really, in a way, the urgency of the transition has meant that we just need to get on with it.
James, I spoke yesterday to a bloke named Stephen Nowakowski, who is a conservation activist, and he spent 3 years mapping every wind and solar project in Australia, upcoming, and it's already been built. So everything in the pipeline. And there are 1,138 projects.
Great.
At a total cost of $1.38 trillion.
Wow.
I mean, can you believe it?
Well, yes. I mean, that's what we need, isn't it?
Well, the total megawatt, the total installed capacity of these projects is 450,000 megawatts. And the total capacity of the grid at the moment is 65,000 megawatts. So
right, wow.
it's many times the amount of electricity we currently use many times. I mean, look, I don't know. This is telling you why the super funds aren't investing in it, because it's overcapacity.
Yeah. Okay, well, one to watch. Our old friend Barbecue Area is back, and apparently this name is taken from a satirical film from 1986 that Barbecue Area thinks we should check out. He says they say, lads, banks and economists have rolled back their RBA rate predictions to May 2026. Why did nobody predict that August inflation would be higher at 3%, given energy rebates were rolling back? Some banks were predicting 6 rate cuts in 2025. Well, I'm not sure any Australian banks or any banks were predicting 6 RBA rate cuts in 2025, maybe in the Federal Reserve. But look, I could be wrong on that. I think there is a good question. I think it's been hard, Barbecue Area, to predict where the economy, the underlying economy, has been going. Yes, the energy rebates were rolling off. That's true. Although I think most economists have looked through those, Alan. They've basically ignored them on the way in and will ignore them on the way out.
Yeah, well, so the surprise in the August inflation number was not the headline rate that included energy rebates being rolled back. It was the trimmed mean, or the non-volatile items.
Yeah,
which went from 2.1 to 2.7%, and that led to everybody saying, "Oh, crikey, the quarterly CPI is going to be higher than expected as well." So that's what happened. It was the sort of underlying or core inflation number that surprised everybody.
Barbecue Area says, are highly mortgaged homeowners screwed? He says yes. Look, I mean, I think this is the one thing it's worth thinking about when it comes to rates, Alan. The question, we get obsessed with when's the next rate cut, and I totally get that. But the question's always been, how far do rates fall? That's what matters, because Barbecue Area makes a good point. I can't believe I keep saying this person's name like that. There is a generation of people who've got used to rates only 5 years ago being incredibly low, and we're not going back there. And I think we're still yet to see how businesses, households, the broader economy adjusts to a higher for longer rate setting. I know it's not high by long-term averages, but it is high for the past 10 years or so. I think it'd just be interesting to see how the economy adjusts to that.
Yeah, I guess if anybody took out a mortgage on the expectation that rates would be cut, that you're gambling, really. I mean, it's not going to. It's possibly a gamble you're going to lose, because you don't know what the economy's going to do.
Yeah.
Lachlan says, you often talk about the private market and companies saying private delisting or being bought out instead of listing. As a retail investor, should I be allocating some of my investments to private markets? If so, what's the best way to do that? And what are the main risks an average punter like me should keep an eye on?
Well, Lachlan, the good news is if you've got a super fund, a normal bog standard super fund, you're already in the private markets. And so you possibly don't need to worry too much about that. Getting into them in other ways is not easy. There are a few listed investment companies that have been set up to invest in private credit and private equity. So that's worth checking out. Pengana has a couple of them. Again, not recommending, not endorsing, just giving you the information. And then there's a bunch of, in America particularly, if you want to get into stocks like BlackRock, Blackstone, KKR. BlackRock's now into private investments and infrastructure investing as well. Ares, Apollo Global Management, Carlyle, Blue Owl. These are all private credit, private equity players that give you a window into that market. Although what's interesting at the moment, Alan, is they are being smoked. They are really having a bad couple of weeks, which is sort of an interesting little signal about the state of the US economy. The broader market's obviously been driven by AI, but some of the real economy stuff, private equity, private credit, seems to be a little bit on the nose at the moment. So just one to watch. But that's one way to do it, Lachlan.
Yeah, and the main risk, Lachlan, is liquidity. You can't get out.
Yeah, although with these listed things, you can get out a lot easier. But yes, to get into the big funds, you really need to be a wholesale investor rather than a retail one.
Yeah. Okay, your turn.
James says, last week you mentioned that CGT was introduced 40 years ago. Therefore, I'm interested in your views on grandfathering provisions. Every time the government seeks to introduce new tax legislation, even if it's to fix an anomaly, the wealthy, the pundits and the lobbyists all scream blue murder and raise the spectre of retrospective legislation and unfairness. They call for grandfathering provisions to protect those who already have their foot in the door. Surely transitioning provisions would be fairer. For CGT, a period could be set at 5, 10, 20 or even 30 years, during which time any sale would have been tax-free, and at the end of that period, the cost base would be set going forward. Surely any professional advisor worth their salt should be advising their clients that the legislation can always be changed.
Oh, yeah. Well, I think the grandfathering is based on the idea that, eventually no one's left before the time,
Yeah.
I mean, there's not many people who own assets that have owned assets for 40 years. I mean, I think Stephen Mayne mentioned Jerry Harvey the other day, that his share of Harvey Norman is 40 years old. So he's
right.
He's right. But look, I don't think...
Look, it may be something in the future, James, that gets looked at. Grandfathering's the easy option, isn't it, Alan? But transitioning over 5, 20, 30 years isn't a bad idea in and of itself, Alan.
No, that's fine. Hans says, the podcast has speculated and pondered about the potential and chaos of Trump's tariffs. Can you tell us, listeners, what impacts we might be currently seeing? Is there still uncertainty of potential impacts? Is it too early to tell? Well, so far so good on that, really. The inflation, the prices haven't been passed through, and I think it's largely because the American companies are still selling pre-tariff stock.
Yeah.
They bought a lot of their stock before the tariff came in, and, they're still selling that, so they haven't put the price up. But look, eventually the price will have to go up. The tariff on Chinese and Indian products is about 40 to 45%. On Brazilian products, it's 50%, and Mexican, it's 50%. On average, the tariff is, I think, 18 to 20%. And then the question is, how much is imported? I don't know. I think that there's going to be an impact on inflation. But so far, it hasn't. And the markets are unconcerned. Everything's fine. All the talk of a stagflation, with inflation going up and the economy declining in recession, is so far not true.
Yeah. The one thing I'd say, Hans, is I get to talk to lots of US economists, American fund managers. They all say it's coming. So as Alan said, companies have been able to fulfill orders through existing inventory, untariffed inventory. That is coming to an end. Companies have also held their prices in the hope that this was all a bad dream, that Trump will suddenly reverse. And look, in some ways that's been partly true. But I think there's a boiling frog here, Alan, in one of these boiling frog examples. If you'd said to lots of investors or business people this time last year, hey, at the end of 2025, tariffs are going to be 5 times higher than they are now, and they're going to be the highest since the 1930s depression, we all would have gone, oh my God, my hair's on fire. But because we've been through this Liberation Day baloney, we now think that we've got back to a manageable level. But the impacts of that is still to come. It'll hit the US economy January, February, March next year, and let's see where A, inflation goes, and B, what happens to the state of economic growth. I think it's all in front of us, actually.
Well, the other part of Trump's policies that is affecting the economy is the drop in immigration, which has reduced the supply of labour. And so most of the economists are talking about double shock, a supply shock from lower labour volumes, and a demand shock from higher inflation. So, neither of those things has yet happened, but probably still will.
Good point.
One more.
Pete from Mandra's question is a good one.
Yeah.
Pete says a couple of points about AI that I think you haven't touched on yet. First one, AI takes money flows away from third world high-tech economies. For example, I used to pay freelancers $1,000 a month to build apps and game components. Now I can do all this myself. And his second point is that when using AI, it searches the information and presents it without any advertising content. Overall, AI just increases efficiencies and removes deadweight overheads. That's an interesting point, Alan, and I reckon in countries like the Philippines and even India, which have been set up for outsourcing, as Pete describes, they would really be feeling the impact of AI at the moment. It's interesting that Pete has been able to entirely replace the freelancers that he was using at fair cost with AI completely. That's quite a little insight, I reckon.
Yeah, I think it's a good point, because I think he's right that people, and not just those in developing countries, will lose out, India and Philippines, etc., because call centres will be taken over by AI as well, and also coding and all that. Yeah. But also poorer members of developed countries, that is to say, beginners, learners, they'll be the first to go to be replaced by AI. And so, I think that's right. And the other thing about AI, which he's pointing out, is that there's not a lot of ads going on, advertising, as there is with Google.
Surely the answer there is yet, though, isn't it?
Well, I suppose so, because these companies that are doing it are spending trillions of dollars on building their AI infrastructure. And a lot of analysts in this area are kind of scratching their heads, wondering where the money's going to come from to service the capital expenditure.
Yeah, I've been on Google calls where they have said that AI search type stuff will be infused with advertising over time, as normal search advertising has been. So I think that is yet to come. But the monetization question is still the big question.
It is.
It's right. Still not entirely clear to me how that's working. I don't think it's particularly working yet. We're still in the if we build it, they will come stage, which I think there's plenty of skepticism around. But just on that point that Pete makes about the third world economies and you made about entrance into the jobs market. There's a great piece in Harvard Business Review recently. Most businesses are sort of built on a pyramid structure, where at the bottom there's a lot of junior workers, particularly, and grunt workers who do the sort of the hard graft, and then it flows up into a pyramid where you've got layers of management leading up to the CEO. And this article was suggesting that you'd more move to a sort of cylinder level where you just need less of everybody. Less of the people working at the base of the cylinder would still be juniors, but they'd be overseeing a bunch of AI agents and bots.
And there'd be fewer of them.
There's fewer of them, yeah. So
I think that's very interesting, a cylinder versus a pyramid, yeah.
Yeah, it's a good way of thinking about it, I think. And the more you think about it, most sectors have that pyramid structure, in white-collar sectors, I should say.
Yeah, well, I mean, however you see it, the way that the capital expenditure on AI is going to be paid for is through saving salaries of human workers.
Yeah, it's got to be.
It's got to be.
The only way AI generates a return is, unfortunately, through cost savings, and the biggest cost in most sectors is labour.
Yeah. Okay, thanks. That's it for today's episode. Thanks, everyone, for listening to today's episode of Money Café. Now, I'll be back next week with Stephen Mayne. Send in your question to themoneycafe@eurekareport.com.au. Until then, I'm Alan Kohler, founder of Eureka Report, which is part of Intelligent Investor and someone who shows up on the ABC.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.